Well, hello there. It's Thursday evening. Financial thing. Thursday live stream. Hope everybody out there is having a wonderful week. It is almost the weekend. In that beautiful British weather, right? Hopefully. Hopefully. It's very warm here in Florida in the low to mid 30s. And the air conditioning is working overtime. It's been absolutely piping hot here. A little bit too much, a little bit over the top, a little bit OTT. But we're still here, and that's what's important. Anyway, I'm going to be talking peer-to-peer lending tonight. And I'll look at a couple of platforms, what's going on in the news, and tell you what's the upcoming schedule. I know Tuesday has been a little bit difficult for me to stream recently. I'm hoping everything works out well. Next week I'll be able to stream on Tuesday and Thursday. Got the healthy green shake today. But yeah, we'll be back hopefully on Tuesday next week too, talking more stocks and cryptocurrency. And I do have some guests lined up. If everything comes to plan for September, we're going to have a good lineup of guests on the peer-to-peer lending side, which could include one of the following, or two or three of the following. Loanpad, Folk to Folk, possibly even David Bradley Ward from AbleRate. So yeah, I'm looking forward to that. It's going to be some good guests coming up in September. So stay tuned. Keep your ears peeled for the updates. If you're not on the email list, go to financialthing.com and sign up for it, because that's where I send out the notifications of the guests for the stream. So, that's not good. No water. Anyway, who needs water, right? Anyway, quick shout out to everybody. Please hit that thumbs up if you can. If you're finding... Oh, Robert Pates. It's here in Greece. I don't know if that's my software or... Let me mute that. Or if it's YouTube going crazy and showing me the same comments over and over again. Let me check. Yeah, my software seems to be showing me repeat comments, but that's okay. It's probably a bug because they just listed an update. I have to report that. Robert Pates is here in Greece. Mark Mason here. Good evening to all. He says, Dave from Staffordshire. Stephen Hale is here. Akichak from Accrington. Colin is here in the Peak District. Paul New, who is not new to the stream. I got jokes tonight. He's here in Stockport. Hi, Paul. Peter Vince, of course, in Leatherhead. Mike Powell is sneaking past the bouncers tonight. Are you going to the club, Mike? Are you going clubbing tonight in Southampton? I used to go clubbing in Southampton when I was a youngster. And I snuck through a few bouncers in my time to get to the bar, but I digress. Let's talk some peer-to-peer lending news. Let's get into it. Okay. Oh, by the way, hopefully by this time next Thursday, we're going to have Financial Thing t-shirts. I don't have a Financial Thing t-shirt on that you can order and get delivered right to your house. And it will be a way for you to support Financial Thing in a very fashionable way, because these t-shirts are going to be amazing. So I will announce that next Thursday anyways, if not before then, but probably next Thursday. Anyway, let's get to it. Here we go. Let's enlarge that a little bit. A little zoom in there for Peter. I know he likes to see it close. Plend, aka P-Lend, but it is actually Plend. They've lent £500,000 since launching in May. They've delivered more than 500 grand in customer service loans since they launched in beta. And remember, they're in beta or beta mode right now. And they have processed more than £7.2 million in loan requests. Only prime borrowers being approved. So that really gives you a good indication of when peer-to-peer lending platforms get loan applications, how much are they actually accepting? You don't want to see a high amount of acceptance because that means you turn into another lendy where you're just pulling in loans to get fees. Plend isn't doing that. They're accepting about, what are we talking, 10%, 8% of their loan requests. So that's a good thing. It means their lending standards are high. Robert Pascoe said, it's been amazing, but it's also been mad. The hardest thing for us has been dealing with so many loan applications. A lot of people are looking to get low-cost credit at the moment. That's kind of one of those difficult things about lending is you got to go through probably hundreds of applications, if not thousands. And I bet that's a pain in the butt. But they supposedly have a more sophisticated way to go through those loan applications. They are targeting £14 million of lending by the end of the year. So I did reach out to Robert today to ask. Oh, look at the red background matches my red background. But I asked him, I said, Robert, when are we going to be able to invest through Plend? Because right now, if you go to the website, there is no place to sign up unless you're an early adopter, which I did not take on that opportunity. But not because I didn't think Plend was a good platform, morally down to moreover funds, not having enough money to invest at the time to get in on the Plend ground floor. But as you can see here, you can only borrow at the moment. If you are looking to borrow some money, it's got this pretty nifty little sliders you can borrow. Shows you the interest rate here. This is how much borrowers are paying. Of course, the longer you borrow, the less that APR goes down. But I did reach out to Robert, and he said that they're looking to launch for lenders in November 2022, which will probably be in some kind of beta mode again. So you can mark that one down on your calendar if you are looking to invest in Plend as a lender. I do have high hopes for Plend, I got to tell you. It's one of the ones that I think is kind of an exciting opportunity. And we'll see if that plays out the way I think it's going to. We got the FCA coming in hard with these new rules that were announced. If you are a peer-to-peer lending company, you now have to put this risk warning on financial promotions, which says, don't invest unless you're prepared to lose all your money invested. This is a high-risk investment. You could lose all the money you invest, and you are unlikely to be protected if something goes wrong. Take 2 minutes to learn more, and there will be a link. These new FCA rules are going to probably kick in early in 2023. So I would say Q1 of 2023. They're also going to make these websites put high client name. This is a high-risk investment. How would you feel if you lost the money you're about to invest? These are pretty emotionally heartstring tugging statements, basically saying there's maybe a chance that you're going to lose all your cash, which, you know, got to give it to the FCA. They've seen it happen before. It's happened to us as old school investors through some of these companies, like possibly Lendy or Collateral, where we may not get most of our money back. So they just want to protect investors. So it says all firms offering high-risk investment must implement the updated risk warning by December 1st of 2022. All other rules outlined in the policy document come into force on the 1st of February 2023. So be prepared to see some funky risk statements. Also, these refer a friend little bonuses, these Brucey bonuses that we used to get for signing up our Uncle Roger, we're no longer going to be able to get those anymore. Those incentives are going to be banned. They don't want you doing that. So this ban will be taking feedback from the FCA by the 10th of October, and the ban's new rules will be confirmed early next year. Again, I think that's going to be Q1 of 2023. So if you are looking to sign up with a peer-to-peer lending company that is offering cash back, things places like Loanpad, you're going to have to do that before they pass this ban, because you won't be able to get those anymore. Those promotions are going to be gone. So the new rules will not apply to crypto asset promotions, as those are still awaiting government confirmation on how the crypto market will be ruled under the FCA. There's an article here, opportunity for peer-to-peer as banks cool on lending. They're saying that banks, shown under recent data, the banks are becoming more cautious with mortgage lending, business lending, and consumer lending due to the pressures of inflation and rising interest rates. This means that many consumers and business borrowers will be unable to receive financing from traditional lenders in the months ahead. What this is going to mean for you as a peer-to-peer lending investor is you're probably going to see, one second, you're going to see more loan opportunities coming onto these platforms as the banks start to say, no, we're not lending money to your investment, to your whatever, your project. And these companies now, or builders, are going to have to go to peer-to-peer lending to get cash because the banks are going to say no. Which is, I think, kind of the way it's always been for SMEs, small and medium businesses. They've never had an easy time going to the high street banks, but as the lending starts to tighten, more opportunities are going to come up in the peer-to-peer lending space. Money & Co. is considering a move to manage accounts only. So if you are investing, there's a Nicola Horlick. Anyway, I don't want to say anything about that name. Money & Co. is considering. So what they are saying, they have a managed portfolio investment where you can pretty much let a professional handle your loans. You're choosing of your loans instead of doing it yourself. Right now they have self-select, which you can do on £1,000 buy-in loans. But it seems to me what they're realizing is that having people manage their own loans is probably not the most effective way to do it for their business or for their clients. What they say is it's noticeable that many clients leave money on the platform earning nothing at all and ignore our emails and calls encouraging them to actually buy loans. People leave busy lives and often financial matters are left at the bottom of the pile. What this does, if you're a peer-to-peer lending company, you have money sat in a account doing nothing, means that the loans that you're offering are not getting filled, and that's a bit of a detriment. So I think they're probably saying, we don't want to do this anymore. We want to get that money deployed so we can write more business. So let's get rid of the self-select, and everybody's going to be on a managed system. What is this managed portfolio system? I went to Money & Co.'s website to check it out. I was wondering, do they have a management fee for doing that? Is it like a Fundsmith stock fund? It says clients of the Money & Co. portfolio service have access to loans with a typical fixed rate return of 7% without need to manage. You'll receive a quarterly statement with details of what's held in your portfolio and all the transactions. As the client, your portfolio will be managed according to parameters agreed with you at the outset. You can elect to have interest from your loans paid out twice annually or returned in your portfolio for reinvestment. Now, I don't know if currently Money & Co. pays out twice annually, but if you're somebody who wants to get your income payment every month, that kind of seems like a bit of a negative to me, because I don't want to get paid out twice annually. Again, who is the professional? It says it is managed by Bramdeen Asset Management. Now, I'm not a big fan of anything managed where I don't have control over what I'm being invested into. So maybe this is a bit of a negative thing, but I guess it depends who's doing the loan picking for you, how well it's diversified. But it's an interesting turn of events for Money and Co. You don't really hear too much about them, in the peer-to-peer lending circles. So I'm wondering what is going on in their business. Crowd2Fund launches a game changer small business exchange. Basically, Crowd2Fund is launching a new secondary market, which they describe as a game changer. The secondary market was relaunched this week with a new name, the Small Business Exchange. It will operate on a trial basis for 3 to 6 months as they test the user experience and business processes. At this time, the platform may introduce an equity element. So this secondary market, the way it works is it will have an element of gamification within the trading, but also diversification so people can diversify their portfolios and deploy more capital into the secondary market. This kind of wording right here scares me, gamification. I don't want to see gamification on a secondary market. There's a lot of different ways the secondary markets work. Every platform is different. I personally prefer secondary markets that are very simple to use, where if I want to sell a loan, I put up on the secondary market at par, without a discount, without a premium, and it gets sold. Whenever there is market pricing, meaning supply and demand really dictates how much that loan pot is worth, I think it gets really messy. And I wouldn't be surprised if the FCA comes down on those types of secondary markets, because they're very, very difficult to understand. Pricing of a loan piece where you have floors and ceilings become very, very convoluted and difficult to understand. Most people don't know how those things are priced or how much a loan piece should be. I think you have this problem with a website like Property Partner where the price of the shares on the property are always moving. And some people are even trading shares on these secondary markets like they would in a stock account. And I don't think that that's what peer-to-peer lending secondary markets should really be there for. They should be there to provide liquidity, which secondary markets do. But I don't think they should be overly complicated. And I do fear that a system like this overcomplicates the secondary market system. The Small Business Exchange sets a floor and ceiling price for each trade. These prices are then set by an algorithm and reviewed by a member of Crowd2Fund staff. The floor price is set on a number of variables, and it adjusts the price based on the performance of the business. The ceiling price is calculated in a similar way by having this moderated approach. It has some level of protection when using an investment because the system has repriced the loans. The benefit of having a floor and ceiling price means that the gamification element is still there. If a seller wants to sell the loan quickly, they can offer a higher price. But if they want to make a profit out of the loan, they can offer it at a lower price. Sounds a little convoluted, a little bit complicated. Like, how are these variables pricing these loan pieces on the secondary market? It just sounds muddy. And it seems like they're very proud of this. And look, I get it. They've created something that they think could add value to Crowd2Fund. But as a consumer, as an investor, somebody who's using it, is it really bringing value to me? I don't buy peer-to-peer lending loans trying to flip them on a secondary market to make a profit. I just want to get the loan. I want to get interest off it. I want to get the money back. I do like the idea of secondary market liquidity. I think that's important. My ideal secondary market, if I was to design one myself, it would be where you could not offer premiums, but you could only offer discounts to keep that liquidity high. If you need to sell something, you can offer a 1%, 2%, 3% discount. It gets moved on the secondary market. I do not like the idea of having premiums being able to be charged on secondary markets, but seems like they do. I was just browsing around Crowd2Fund's website, I wanted to look at their outcome statement because I'm just curious about the statistics. We haven't had one. Actually, this is the year ending April 30th of 2021. This is their outcome statement. They've had a default rate hike up to 6.1%, which is less than the predicted 6.58%. Probably, again, because of the vid situation has created a lot of issues. Consequently, the adjusted actual default balance for the period to April 2021 is 8.41%. So, you know, they do have some defaults there. I don't know how big the loan book is. It doesn't tell you that on any of their statistics page, but I was looking. I did sign up for an account just to look and see what they have going on there. Turn this off. They have, you know, several loans that are paying pretty decent APRs, 15%, 14%. So there is opportunities there. Again, I really would like to know how big their loan book is, because I don't know. Let's see. Platform statistics really doesn't tell you anything about the size. It just says how much has been made investments over the entire loan book. Last updated August 2022, 41 million invested, average APR 11.46% with 628 loans issued. So they do have a pretty good history, 5.5% default rate and 3.08% written off. That means that 3.08% is completely gone, which is technically a write-off loan. It means you're not getting your money back. So pretty small, but again, how big that loan book is, I don't know. Interesting secondary market take. This is the credit risk performance update from LendingWorks as we await to get the money returned from them winding down their loan book. It says in Q2 2022, we have continued to focus on understanding the impact of cost of living challenges, blah, blah, blah. Both expected annual returns and expected annual loss rates have remained relatively the same for LendingWorks in Q1 as compared to our Q1 2022 update. We are pleased to inform you that the interest rate diversion to the shield will be reduced for the 2017 to 2019 cohort of loans, and the 2020 and 2021 loans will continue to pay the target interest rate. Let's look at the statistics real quick. 70.9 million pounds under management. You see the weighted APR. This is what borrowers are paying, average 13.5%. This is what you are getting, 4.0 to 4.5%. What a spread. It's a hell of a spread for LendingWorks. Now you can see here, interestingly, their expected annual loss rate is 3.7 to 6%, whereas here in 2020 it was 3 to 3.0, 3.3%. So their expected annual loss has risen quite substantially. And then here's the shield balance, which is only 5.48% of the total amount of that loan book that's covered by the shield. So 1.2 million pounds of cash in the shield, and then total amount of outstanding shield covered loans is 21.9 million. So not all of the loans are covered by the shield, because they have 70.9 million under management, but only 21.9 million is actually covered by the shield. So just paying attention to these numbers, because you know, if you're a LendingWorks investor and you're kind of looking at what's going on behind that company, saying, oh God, I hope that they're going to pay the money back. I hope these loans don't run into trouble. Always keep an eye on it. It is important. Let's move on to Property Partner. We don't really talk about them that much, but I've got some investments still with Property Partner, and they put out a July 2022 portfolio update. Interestingly, net cash across the portfolio is a surplus of 1.2% of the property value. They're expecting mortgage rates to increase, which will likely increase the cost of their mortgages, because Property Partner has a lot of mortgages on the properties that they offered. And they've had a sale of individual units within residential blocks of 27 units completed, which has reduced the loan-to-value ratio across the portfolio from 53% to 49%. But it also reduced the dividends of property where it's necessary or advantageous to use net rental profits to reduce the mortgage principal. So what they're doing is if, say, property A has a mortgage and they want to try to reduce that mortgage because they're trying to reduce the debt on the entire portfolio, they're going to spend or reduce dividends that you are being paid as an investor to pay down the mortgage. Now, this is one of the things that when I first started writing about Property Partner, and you can read it on my review, the mortgage side of the things does make things complicated because ultimately Property Partner has the control over how those mortgages are handled. And I always wondered, what happens if Property Partners stop paying on a mortgage? You know, because they are the ones making payments and they have quite a considerable amount of debt leverage. But what they're going to do, again, is move some of that money into reducing mortgages because they see the interest rates hikes coming, which is going to make those mortgages considerably more expensive, which means the performance of the loan book will decrease, so on and so forth. So you may see some of your dividends if you're a Property Partner investor start to decrease. Dividend changes across the portfolio. We are reducing the weighted average dividend yield from 3.3% to 2.9%. There you go. So they're going to cut what you're making, even though it has actually risen up quite a bit from where it was in 2021 when everything was just kind of at a standstill because of the vid. Property development loans. I was always a bit of a bagger on these. I used to give them a hard time about these because they were second charge lending loans. But it says we have successfully repaid 2 development loans this quarter, which one of them total return of 26.1% after all fees, equivalent to an interest rate of 9.2% a year. And then another was repaid in full, which averaged about 10% a year. So those were obviously over a couple of years. I always thought second charge developments where you're being paid 10% or 9.2% as a return is not a good return for a second charge loan. So you can see that while those results do look good because you look at it and go 26.1%, that's a good return. But if you average it out over the amount of time those loans are actually running, came out to be 9.25% and 10%. But at least they were paid back. So of the 16 development loans that our clients have funded, 9 have been repaid in full with interest. So I would say that is a good situation. Now, this is another interesting thing here. 7 properties with fire safety issues. They have, and I'm presuming this about the cladding, right? Because they've had problems in the UK about these high-rises not having adequate fire protection in the cladding on the outside of the building. And upgrades have to be made on those buildings, which can be quite costly. So you can see they have 8 properties impacted, which is probably going to be significant expenses on these 8 buildings right here. My goal has been to exit out of Property Partner. I'm probably going to look at the portfolio soon and maybe even just sell the shares that I have in there because let me log in here. Let me do some number here. I don't remember. There we go. See what they got going on in the background. live trading. This is one of the things I was talking about too with the secondary market. Property Partner, here you can see these share prices up here for these properties change constantly, right? This is the convolution of secondary market within Property Partner. But one thing that concerns me about this business is that they don't have anything new, at least that I have seen, coming onto the market. If we go onto the most recent, let's have a look on this one was put up. This is a student building in Aberdeen. You can see here the 5-year anniversary on this is October 2024. So that means this was written in 2019. So they have not written any new business in this Property Partner company since 2019 October. Slightly concerning because how does a business make money? Well, they make money by writing new businesses, bringing new properties onto the platform to sell shares, and Property Partner is not doing that. So one wonders, what is the game plan here for Property Partner? Is this going to be another wind down situation where they just don't see the company as being a feasible prospect anymore and it gets wound down? I don't know. Time will tell. It's pretty interesting. What else we got? Assets Exchange had a new, where is it? Exchange. They have a new I can't find it. I think it was Golden Lane Housing. They have a new business that's coming out. Let me open up my email real quick. They have a new house that they're going to be putting up. I have to find it. No. Bear with me for a second. Here we go. So it was already launched on the exchange. Let's learn more. I think this is the one. This one came to me at 6 o'clock. No, about 5 o'clock UK time. Here we go. 340,000 pounds. Yeah, there's still availability on this one. This investment consists of the purchase of 2 large semi-detached houses in Stockton-on-Tees that will be being used as a veterinary surgery. They've gone under a refurbishment and have been converted into 6-bedroom HMOs leased to Mears Limited. That will help fulfill their asylum seeker government contract. Sounds like they're going to lease the rooms out to asylum seekers. Okay, so that is available. And there was another one that I saw. Where is it? I don't know. I can't seem to find it. There's another one. It's like Golden Gate Housing or something for a single person who was going to require assistance. So I thought that was cool. Also, Blend Network, they got this loan coming out. This is the tranche 3 of Swansea. So if you're looking to get in on a Blend Network deal, that one just got announced today. And then finally, last but not least, I've been getting a ton of emails about cryptocurrency, like where should you store it? So obviously there's been some issues with the platforms, some of them running into trouble, especially the American ones. So I've been saying to people, look, get your cryptocurrency. If you own any Bitcoin, any significant amounts, you got a couple of £100 worth, look, it's not really worth doing this, but if you have anything significant, get your cryptocurrency off the platforms. Even if you're on Coinbase, there is no guarantee that these platforms survive. There is always also that possibility always that, as we've seen in the US, a couple of the big ones, like Celsius, also, what was the other one? Voyager, bankruptcy protection, lost your crypto, possibly. So people ask me, what do I recommend? This is what I've been using myself. It's called a decent biometric wallet. Basically, this wallet does not hold your cryptocurrency, just so you understand. It is just an authentication device that allows you to store it on the blockchain. And it has a little fingerprint scanner right here. It's very easy to use. This is what I've been using. You can use the other wallets like Ledger or Trezor, but I found this one to be really good. It has an app that connects to your phone. Again, it doesn't hold any of your cryptocurrency. It's just really an information device to where you can access, your assets stored on the blockchain, the information for them. But what it does is it gets it out of the hands of the platforms. If anything happens to those platforms, if God forbid Binance or Coinbase went out of business for some reason, we get a black swan event, you don't have to worry about that because all your information is now stored on this thing. People ask me, what happens if you break this device? Nothing. You can just get another one, because what's going to happen is it's going to give you a bunch of security keys that you need to keep and secure in a secure place, like a safety deposit box. Just hide it in your house somewhere, and you can just get another one of these devices. If you needed to, you'd be able to put in those key words and it would bring up your assets. Now, as far as I understand, you would be able to use those keywords on another device that was not connected to this company. So possibly like a Ledger wallet, if you decided to switch to that, you just use those keywords the same way on a different type of wallet. You'll be able to pull up your assets. But this is by far the absolutely most secure way that you can hold your cryptocurrency. And what I like about this too, when you get your seed words, your security words, it's not connected to the internet. So there's no way somebody could be spying on you to get those security words. It's all done offline, which I love. And this is what the app looks like here. It's really easy to use. It shows you what your value balance is. Wow, look at that. Somebody's got $1.7 million. That's a lot of crypto. So yeah, I've been getting asked that a lot recently. What do I use? This is the one I use. So it's got good reviews, good ratings. It's called the Decent Biometric Wallet. So for all you crypto people out there, you got any significant amount of cryptocurrency, and it's worth it, because you can see this is 116 pounds. So if you got 200 pounds worth of crypto, don't bother. There's no point in doing it. But if you've got a few £1,000s worth, spend the money, get yourself a wallet, and feel safe. So there you go. That's what I got for you today. What time is it? 8:09 in the PM. Let's see. I'm going to try to get out of here early today. Wow, 43 minutes. Okay. What went wrong on Tuesday? I tell you what went wrong. My email system sent out an email. I don't know. I must have created it and then forgot to delete it, or maybe it was for next week and it just sent it out. And then I was never planning on streaming on Tuesday. Yeah, I know it was set to private because there actually was no stream. So the likes of Loanpad have to declare that they are a high-risk investment, but sellers of a single company shares don't. Crazy in my opinion. I agree. It's been, the FCA has blanketed the entire peer-to-peer lending space to be considered as highly illiquid and highly risky because of the illiquidity, as Mike says. Bram Dean is Nicolaholic, aka the Superwoman. I agree. If the exchanges like Coinbase go down, how would you be able to sell your Bitcoin? I mean, there's always going to be places you can sell Bitcoin. It would be virtually impossible that every single platform went down. But if one of them goes down, you can always sell your Bitcoin on another platform. If you hold it on a hardware wallet, you can send it wherever you want. So you could send it to Binance to sell it. You could send it to FTX. And it's just, the main thing is you're in control of your assets and not some platform. So it's just the safest possible way. You do have to worry about losing those key phrases, because if you lose those, then you have no way to access your assets. So don't lose them. I mean, it's good to write them down in 3 different places. Some people put them on metal. They engrave the words into a piece of metal and then put it in a safe, or you could give the words to a family member and don't tell them what it's for if you wanted. Somebody you trust. Not a biggie. What are my thoughts on Cufflink's mezzanine loans? I don't tend to invest in mezzanine loans unless the interest rate's really super high. I just don't think it's worth it. I'm not saying anything bad about Cufflink's mezzanine loans. I just don't like second charges or mezzanine loans in general. So I've always been sort of the first charge advocate, first charge loans. I think in order to do things like mezzanine second charges, the interest rates are they're never high enough. I think you need to be at least in 12% for me personally to take the risk. First payout for money thing today, is that right? I have to check my account. Did they send out an email? I don't think I got one. That's on a defaulted loan. Okay. All right. Sounds good. Listen, I'm going to get out of here. Hope everybody has a great weekend. Hopefully back next Tuesday. Please hit that thumbs up if you can before we sign off on the stream. And always a pleasure. Love each and every one of you. We'll be back next time. Have a great weekend. Take care. Bye.